complaints by banks over ever more onerous compliance obligations are well rehearsed and frequently expressed with feeling. Banks often saw compliance primarily as a defensive function, a department regarded as something of a potential adversary, necessary only to satisfy regulators, avoid fines, and prevent reputational damage. Compliance was more of a cost center rather than a source of operational or strategic value. That perception is increasingly outdated. Indeed, regulators themselves are encouraging banks to view stronger compliance capability as a support to better governance, better decision-making, improved operational efficiency, and safer innovation. Regulated institutions are coming round to the notion of treating compliance not simply as a regulatory obligation, but as a business capability. The commercial case for modern compliance capability rests on three closely connected propositions. Stronger compliance data and governance improve strategic decision-making across the institution. Better data aggregation and control frameworks improve operational efficiency and reduce losses. Emerging technologies such as artificial intelligence can only deliver sustainable business benefits when supported by strong governance, data quality, and control structures. Quality data as a business asset. Historically, many banks operated as a collection of siloed businesses with fragmented systems, inconsistent data definitions, and disconnected reporting structures. Compliance, risk, finance, and operations often worked with different versions of information. This weakened management, oversight, and made decision-making slower and less reliable. Regulators are now making the case that high-quality governance and data architecture are not simply compliance requirements, but strategic assets. The European Central Bank's 2024 guidance on effective risk data aggregation and reporting highlights that accurate, integrated, and accessible data can support digital transformation, strengthen strategic steering, and improve profitability over time. Better data allows management to identify emerging risks earlier, allocate capital more effectively, assess customer behavior more accurately, and improve operational planning. A bank that has strong integrated compliance and customer data should be able to identify recurring complaints associated with a particular product feature before the issue escalates into a major conduct problem. Stronger transaction monitoring data can help identify emerging fraud patterns earlier, reducing losses and customer disruption. The ECB also links stronger governance to operational efficiency over the long term. Many banks are still mired in legacy technology environments that are characterized by duplicated systems, manual reconciliations, and fragmented reporting processes. These structures are expensive to maintain and contribute to operational risk. Ironically, modernizing compliance and governance frameworks often has the effect of forcing institutions to rationalize systems, improve data architecture, and automate workflows. In other words, compliance obligations become the trigger for systems improvements. Risk data aggregation supports profitability. The second proposition supporting the business value of compliance is that stronger risk data aggregation and governance improve efficiency, reduce losses, and support profitability. The Basel Committee's principles on risk data aggregation and risk reporting emphasize that firms with stronger information management frameworks are better positioned to manage crises, monitor exposures, and support strategic decision-making. Many major banking losses have historically been linked not simply to poor decisions, but to inaccurate or delayed information. The lesson of numerous financial scandals and operational failures is that weak data aggregation can prevent firms from understanding concentrations of risk, customer vulnerabilities, operational weaknesses, or exposure to third parties. Improved compliance capability reduces these risks by creating more structured, reliable, and timely information flows. This results not only in operational savings, but the reduced probability of major financial losses arising from regulatory fines, remediation programs, customer compensation exercises, and reputational damage. AI benefits depend on governance and data quality. The third proposition concerns artificial intelligence and emerging technologies. Banks are already seeing practical benefits from AI through improved productivity, customer service, fraud detection, and anti-money laundering controls. The view of regulators, however, is that the benefits of AI depend heavily on the quality of underlying governance and data frameworks. AI systems are only as reliable as the data and controls supporting them. Weak governance can create serious risks involving bias, inaccurate outputs, poor explainability, customer harm, or flawed decision making. Reaping the benefits of AI is not about aggressive deployment. Rather, firms with mature compliance capability are better positioned to govern AI safely because they already possess structured escalation frameworks, risk management disciplines, data governance controls, and oversight mechanisms. Ultimately, competitive advantage will not come from weakening compliance obligations. It will come from industrializing compliance, effectively embedding it into systems, governance, data architecture, operational processes, and strategic decision-making. The banks that succeed will increasingly treat compliance not as a constraint on business performance, but as part of the infrastructure supporting resilience, trust, efficiency, and sustainable growth.